Welcome to another episode on Cash Ops, where we unravel the intricacies of investing to help you make smarter decisions with your money. Today, we're delving into a topic that many investors misunderstand: the allure and the pitfalls of dividend investing. It's easy to see dividends as a direct pipeline to passive income, but there's a lot more under the surface that could be chipping away at your financial future. Imagine this. You've invested in a company renowned for its consistent dividend payouts. On the surface, it appears you're earning steady cash just by holding shares. Sounds like the dream, right? But let's peel back this layer and see what's really happening. When a company pays out dividends, it's essentially transferring a portion of its profits from its bank to your pocket. This transaction makes the company worth slightly less because it now holds less cash. There's a common misconception here that this process creates new wealth, but in reality, it's merely shifting money around. The overall value of the company doesn't increase, only your personal cash flow does. Now, why is this problematic? Because it masks the real impact on your investment's growth potential. Every dollar paid out as a dividend is a dollar not reinvested into potentially profit-generating projects, like expanding operations or innovating new products. This might not seem like a big deal initially, but over time, it can significantly affect the company's growth trajectory and, consequently, your total returns. Let's break it down with an example. Suppose you're eyeing a stable, dividend-paying stock, perhaps a big name in the consumer goods sector, like the fictional Blue Chip Goods. Blue Chip has a strong market presence and has been increasing its dividend payouts regularly. This seems promising, but what if Blue Chip's focus on rewarding shareholders directly is causing them to lag in competitive areas, like technology upgrades or market expansion? Here's where the concept of total returns comes into play. Total returns consider both the capital gains from the stock price rising and the dividends received. If you're only focusing on the dividends, you might be missing out on higher growth potential elsewhere. For instance, while Blue Chip stock provides a steady 4% dividend yield, its stock price growth is sluggish compared to tech industry stocks or a broader market index like the S&P 500, which could have yielded total returns of, say, 10% annually over the same period. Halfway through our discussion, if you're finding this analysis valuable, don't forget to subscribe to Cash Ops. Your support helps us bring more insights directly to you. So, is chasing dividends inherently bad? Not necessarily. It's about understanding what you're sacrificing for those payouts. Investors often fall into the dividend trap, where the appeal of immediate cash blinds them to greater growth opportunities. This is particularly risky in volatile markets or industries undergoing significant changes, where adaptability and reinvestment are crucial. As you contemplate dividend investing, consider diversifying your approach. Don't just look for high yields. Investigate how these companies are reinvesting their profits. Are they buying back stocks, thus potentially increasing the value of remaining shares? Are they funneling earnings into research and development or expanding into new markets? Dividend investing is a strategy that focuses on generating a steady stream of income through dividends paid by stocks. This approach is particularly favored by investors seeking a reliable income, often in retirement, or those looking to reinvest dividends to accelerate portfolio growth. When a company earns a profit, it can choose to return a portion of those profits to shareholders in the form of dividends, which are typically issued on a quarterly basis. Investors attracted to dividend investing often look for companies that not only pay dividends, but have a history of consistently increasing their payouts. These companies, usually well-established and financially stable, are perceived as less volatile investments. They are often leaders in their industries, having reached a maturity stage where the high levels of capital investment are no longer necessary, allowing them to return excess cash to shareholders. However, dividend investing isn't without risks or drawbacks. One key consideration is the opportunity cost of investing in slower-growing, dividend-paying companies versus potentially higher returns from growth stocks. Growth stocks reinvest their profits back into the business rather than paying a dividend, which can lead to a higher potential for capital appreciation, but comes with greater volatility and risk. Moreover, investors must consider the tax implications of dividend income, which can be taxed at different rates, depending on the investor's overall income level and tax laws, potentially affecting the net benefit of dividend payouts. In conclusion, while dividend investing can offer a predictable income stream and a perceived safety net during market downturns, it is crucial for investors to balance these benefits with the potential for slower capital growth and tax impacts. Diversifying one's portfolio to include both dividend stocks and growth stocks can provide a balanced approach, leveraging the stability of dividends while still capturing the upside potential of faster-growing companies. As we look ahead to 2024, the stock market presents a complex landscape shaped by numerous economic indicators and geopolitical events. After the volatility of recent years, primarily driven by the pandemic and subsequent recovery phases, investors are keenly watching several key factors that could influence market trends in 2024. Firstly, inflation remains a critical concern. After significant global inflationary pressures, central banks, particularly the Federal Reserve, have been in a tightening phase, increasing interest rates to curb inflation. How effectively these measures control inflation without tipping economies into recession will be pivotal for stock market performance. If inflation continues to ease, we might see a more accommodative monetary policy stance, which could bolster market confidence and support equity prices. Secondly, geopolitical tensions and trade relationships will continue to influence market sentiment. Ongoing issues such as the U.S.-China trade relations and political instability in key regions could affect global markets, impacting international trade and corporate earnings. Furthermore, sector-specific trends will also play a crucial role. Technology and green energy sectors might continue to see significant interest as advancements in AI, electric vehicles, and renewable energy capture investors' attention. Conversely, traditional industries like oil and gas may face challenges if the shift towards sustainable energy accelerates. Finally, corporate earnings will be a significant driver. If companies can continue to post strong earnings growth despite economic headwinds, it could provide a crucial underpinning for the market. In summary, while the forecast for the stock market in 2024 remains cautiously optimistic, it is tempered by the need to navigate inflation, geopolitical risks, and sector-specific shifts. Diversification and vigilant monitoring of economic indicators will be essential for investors navigating this uncertain terrain. Investing isn't just about passive income, it's about active growth. A balanced portfolio might include dividend stocks for steady income, while also holding growth-oriented stocks and index funds that capture broader market gains. As we wrap up today's discussion, let's consider the broader implications of your investment choices. By focusing solely on dividends, are you potentially missing out on significant growth opportunities that could compound more substantially over time? Thank you for tuning in to Cash Ops. If you enjoyed this deep dive into dividend investing and want to see more content like this, please like this video and subscribe to our channel. Your engagement helps us grow and continue providing valuable content. Here's to making informed financial decisions and maximizing your investment returns. Happy investing!